Hey guys, it's been a bit since I've done a video. In my last video, I believe I was actually short-term bearish. I told you guys I was short. That particular short I was able to close out for actually a pretty nice gain. Almost a perfect trade, which is pretty rare. And then I did get back long, but not as much as I should have. So I was able to ride it up a little bit. And then I did switch back to bearish, started shorting again. That short worked, but I got shook out of it way too soon. So now my positioning, just to keep you guys updated where I'm at, I'm net long, and I am going to be looking to buy this dip for sure, just not quite yet. But I do think it's a buyable dip. I think right now this market is very similar to fall 2019 in terms of a market that's coming off kind of a euphoric sentiment and slowly been sliding lower on sentiment. And that reduction in sentiment off high levels is what's bringing the market down. It's not a market that's coming down from extreme euphoric levels and just immediately coming down. It's a market that went up despite the euphoria. And now, because sentiment is finally weakening, it's pulling it down, which is very similar to what we had in the fall of 2019 and ended up being extremely bullish. And yes, I know eventually March 2020 happened the next year, but there was a lot of extenuating circumstances with that. It didn't necessarily have to happen. Some things could have went differently and that wouldn't have happened. So I do think this is similar to September timeframe of 2019. But before this little pullback here, there were some warning signs. I'm not saying there was overwhelming evidence or anything like that. There's a few warning signs. This one that I posted on Twitter, the DIX+GEX sell signal 2.0. Go back to some videos I made in March and blog posts I made in March on this to understand how that works. It's not super complicated. Anyways, it does have a somewhat bearish backtest compared to most backtests out there. There's not very many backtests you'll find with a sample size of 64 that are actually average negative going forward 1 month. And with this, there was also a lot of clustered signals that I did not remove in 2017 where that market just defied everything. And if you remove those, it actually becomes quite a bit more bearish. So this is actually a metric that I am a big believer in, I would say. It's not everything, and you can't just sell the S&P 500 because of one signal. You need confluence. And even then, it's in general not a good idea to short the S&P 500, like basically ever. Even in a bear market, I would contend that it's not necessarily a good idea because bear markets, there's so many whipsaws where you could easily just get taken out of that short real easily. So it's not necessarily a thing where you would just, even in a bear market, it's a thing that always works, right? Next, this is the DIX, and here was where we got these clusters of low DIX prints that caused that sell signal to happen. An encouraging thing, and one reason I think this pullback could be a lot smaller than I think a lot of people think. A lot of people are calling for a crash here, which they've been doing, I guess, since 2008. And we're right one time in March 2020. We have DIX that came back to life here, which is very good for the bull case. And this is one reason why I don't think this will be a massive pullback here. And I want to be a buyer of this dip, but like I said, not quite yet. I'd like to see a few more things first. FANG, this is the FANG DIX, and FANG DIX is what brought down the regular DIX. It printed 0.4169 on Friday versus DIX of 429. So what that means is FANG has been printing very low on DIX, and it's definitely due for a pullback. It's been what's been carrying us up the last few months. after everybody had given up on FANG. If you look at total DIX, it printed a 46.7 on Friday. So there's a lot of dark pool money flowing into the smaller stocks is what that tells you. What's that mean? Well, it means FANG might cool off, which would probably bring the indexes down. But that means that I think you probably want to be buying the cyclicals and the inflationary names and stuff that everybody's been panic selling recently. I think they're better buys. Once we come out of this correction, however deep this correction ends up being, those are the things you want to buy. And I think you ditch FANG for a while, and NASDAQ possibly. Yes, insiders did sell lots the last week. Another thing that could mean we go a bit lower, doesn't mean we crash. Retail, this is the story of this entire uptrend since March 2020. Retail has been bullish, very bullish. Institutions, not so much. Institutions have occasionally gotten a little bit bullish, but not bullish the entire run-up, that's for sure. And it doesn't mean that retail is killing it, because retail is YOLOing calls, and that just doesn't work near as well as you think it does, or as a lot of people think it does. So a lot of those guys are not making as much money as you might think. Breadth. This is one thing I'd like to see, is a further breadth washout before I get bullish again here. So what we typically have been seeing, and this is not just a 2021 phenomena. People are talking like these patterns we've been seeing with OPEX. This is only something we see recently. We've been seeing these patterns for 10 years. They're a little bit more pronounced now, but this is not a new thing. But basically, the market, I do kind of think this market, I'm not an Elliott wave guy at all. I'm not trying to make that point, but corrections in the S&P 500, even these little small ones, do kind of follow the ABC Elliott wave pattern a little bit. And ABC does not necessarily mean low or low. It can be something like this. Well, I didn't draw that right. Let's try that again. It can be a double bottom too, right? I mean, I've read up on Elliott wave. I've read up on every technical analysis indicator that's ever existed. For the most part, all the methods, the Wyckoff, which, Wyckoff, I wouldn't say I'm a believer in it, but things like the up thrust above distribution and things like the spring, I do think make sense. I think that makes sense, and you do see these, especially on shorter time frames. You do see those little liquidity hunts where they'll blast through a level, and you get a failed breakout, and then you head lower, or you get a failed breakdown, and that ends up being the bottom. That does happen quite a bit. There's always that one last little fake out, and that's what a UTAD or a spring is from Wyckoff. But anyways, diverging a bit here. Elliott wave, I've read up on it, and these guys always cite these statistics, these Elliott wave guys. I've never seen the actual statistics, the actual backtests. Like there's this one guy, I've followed him for a while. He claims that, what's it called, like a pullback into what he calls the golden zone, which is the 618, and then there's like a Andrews pitchfork or something he puts on it, and if it's in the pivot of the Andrews pitchfork and it's the 618 retrace, he's like, this is like a 90% probability it's going back to the median line, which is usually a pretty big upwards move. I've never seen the actual data, like here's the signals and here is the return. I've never seen it. No one's ever showed it. So where do these guys get these statistics? I always find that funny. Anyways, Elliott wave, I do think is somewhat applicable in terms of the ABC thing, is very common in these corrections. You see it over and over again where we pull back and you get like a retest type of look. You see that over and over again, even on these smaller type corrections. Now, sometimes the secondary pullback is pretty small, like that one, right? And here's like a really small one, but here's your up thrust above distribution look for Wyckoff, and You know, you could maybe call that a spring, even though a spring would technically go under that low. Anyways, what I'm trying to make the point here is, I'm sorry I'm being so long-winded. ABC style corrections pretty common in the S&P 500, so I think it kind of works in that regard. And in terms of breadth, this is percentage of stocks, all stocks that are up on the day. Usually what happens is you get, I'm going to do one of these smaller ones because I think it just works a little better, but usually, yes, you get at least one breadth washout day. Like here we had a breadth washout day, right? And then it followed up with a retest, and this one was actually a lower low, and another breadth washout day on the retest. That's kind of what you see in these corrections. And where you want to get more bullish typically is on the retest. Even if it's a higher low type of look, that's where it's just a safer buy. After you've had a washout, bull trap, retest, and a second washout, that is where the better buy typically is. And it's not just this year. And yes, this pattern that we've had since fall last year, where we just grind up and we have every dip gets bought, eventually, yes, that breaks. Eventually we're going to go lower than the previous low set. That is eventually going to happen. But I don't know when that's going to happen. Nobody knows when that's going to happen. So the probabilities do line up pretty favorably when you get a breath washout followed by a second breath washout and a retest of a previous low. Now, I don't know exactly the best way to quantify this. I've been trying to figure out a way to really quantify this properly, so I can have some actual empirical evidence, unlike what I see a lot of people do, which is just draw random lines everywhere and say, this is giant bearish wedge, we're all gonna die. Those sort of things, right? No backtest, no nothing ever. It's just, I'll never understand this. Like, I'm gonna diverge again, okay? But I'll never understand how somebody can look at this chart, okay, and their thing that they're going to do in their life is call generational tops on this chart. How many generational tops have we had? Maybe one. Maybe you call that a generational top. Maybe that one, and that one. That's it. Since 1872, maybe that one, when it first started. I don't get that mentality. I'll never figure that out. Why there are so many people that are just permanently bearish. I mean, there's so many other markets you could be permanently bearish. Oddly enough, a market that you could be permanently bearish and do a little better in is gold, which is what the permabears all love. And yes, over time it does have a slight upwards bias, but nothing like what this has. So I don't get it. Anyways, I did kind of try to do some back tests for you guys of this. So less than 10th percentile up issues percentage, which I think was like 20, I want to say 27% or less is 10th percentile. So you get under this line here, roughly. There. So all these prints under here are well, it moved because, yeah, it moved. But anyways, hopefully you guys saw that. All these prints under this line are the ones that we're looking at, all right? And yes, as you would expect, it's bullish because breadth works the opposite of what people think. When it's really negative, that's typically more bullish long term. And yes, their risk reward's a little skewed because, yes, there is some big losses in there because sometimes these negative breadth thrusts, or whatever you want to call them, are just the start of a bigger move lower, right? That does happen. But 70, 80, 90% of the time, that is not the case, and it's actually a buy. Now, trying to quantify this whole, clusters scenario or concept that I'm explaining with the ABC correction, basically on the S&P 500. So this is at least 2 in the last 21 days, so in the last month. And Shorter term is, if you compare this to the previous one, it's a little bit lower, but longer term it's better. So it can, because you probably see a lot of these in bear markets, that's probably what drags the averages down a little bit. But it's also what boosts the long term, because what happens after a bear market is very, very, very good times for a long time. And that's the other thing. We just had March 2020, kind of a nasty bear market. And so it's something still to this point you need to factor in as why it may be a while before we get a more of a bearish period, like even like an 18 or like a 15, 16 type period. It might not be till next year till we see that. And like a bigger bear market, that could be a long ways off. And there's nothing that says that it has to happen either. I've heard a lot of people, they talk about this. Everybody has a bullish bias because we haven't seen a bear market in so long. That's what people say. Well, we just saw one bear market for sure. And I mean, if you look longer term, the market in my lifetime has had 2 of the biggest bear markets, actually 3, in its entire history have happened in my lifetime. Versus we haven't had something like this. How many years is this? From 82, so like 18 years. So even if you exclude March from 09, so we're not even, we still haven't quite gotten to the point of a bull market as extreme as, or as beautiful as that one, have we? So what I'm saying is maybe the recency bias is skewed towards bears, possibly. I mean, you could make that argument that we have seen a lot of bearishness in our lifetimes, anybody that's my age or older. And perhaps we haven't seen these really smooth sailing times as often. And maybe everybody's bias is towards bearishness instead of bullishness. I know a lot of people are going to be laughing at me, and look, I was watching this permabear YouTuber that just popped up in my feed today. So I was watching that while I was getting this video put together. And first thing I always do when I see these guys is I look at their history. And he's been posting since 2018, and it's been bearish the entire time, calling tops nonstop. Has 150K followers. Sells a course that's like $500, has a trading service, and I can pick apart at least half of what he says very easily. And there is one thing I am going to pick apart from him. I'm not going to name him. I'm not a name and shamer. I'm not going to attack him. I don't believe in attacking somebody I disagree with. I'll let everybody else on the internet do that. This is why I avoid Twitter so often, is because it's just constant bickering back and forth that I find completely unproductive and pointless, to be honest. But that being said, yeah, sometimes I want to pick these guys apart and I want to call them out, but I don't want to be that guy. But this chart, what I'm trying to say here is 2019, this fall period, I think we have some similarities here. So I think we might have this kind of setup, this sideways, highly volatile setup, going into like maybe late October, early November before we break out. And I think the end of the year we end very bullish. And I think like a longer term, bigger shock, it's probably mid 2022 at the earliest is my view. But let's see what happens when we get there instead of trying to look that far in the future. Index put call ratio has been quite elevated for a while compared to 18. And yeah, I guess they were correct in 14 or 15 going into that event. But this is one thing to me that does give me a little bit of bias towards maybe we won't have a huge pullback here like everybody seems to think, because people are properly hedged, at least at the institutional level. It's when the institutions get unhedged, that's when we have massive issues typically. And you can see in the open interest as well, people don't look at open interest for whatever reason, but the open interest has been climbing in favor of puts, and it did get a little weak, but it has been improving again. So I think institutions are fairly well hedged here. Seasonality kind of fits in with maybe a little bit of sideways volatility for the next few months. Commitment of traders there was a big sell off in dealer positioning. They have been adding to longs while the institutions have been hedging aggressively the last few months, and they're still not extreme low levels like they were in 20, or they were even right when they sold heavily right before the Volpocalypse. So I think it's still healthy enough to keep this at a small pullback here. The other thing is sentiment has been waning. So basically, if this is going up, sentiment is waning. It's coming off these euphoric levels, and nothing happened except we went up. Although under the surface there was carnage. There's been under the surface correction since March. So with that in mind, it's hard for me to imagine that we could have a big, huge sell-off here, considering we've had so many under the surface corrections, and a lot of stocks are still way off their highs going into this. So this is very similar to the setup we had in 18. Sentiment was kind of bullish before that, and then people got bared up, and it brought it down. And then we were good. We broke out after that, after we got people good and bared up. This as well is one of my favorite sentiment kind of gauges. It's come way off its highs. It's hard to imagine we'll have a crash. Usually before the COVID crash, this thing was very high. January of 20, it was 7.2. We're unlikely to have a crash when there's a lot of fear already out there. Same here. Yes, we were very euphoric, but it pulled back, and indexes went up while it pulled back. And eventually what happens is people sometimes read sentiment wrong. Extreme bullish sentiment is not necessarily bearish. It's where it can be a problem is when you come off these extremes and it starts to come down. And if breadth was like extremely bullish this entire time and no stocks were off their highs, and we were seeing this now, it would be a big red flag. But because a lot of stocks are well off their highs, sentiment waning, all that really is going to do is potentially set us up a little bit sideways, trap some people short, and then we're going to probably go higher. Historical volatility. Yeah, I think I put this chart in the wrong spot. But this is the historical volatility. This is implied volatility. So this is VIX minus the 30-day historical volatility is what this is. So big spikes on this. I published this on TradingView this morning, but big spikes on this basically mean that implied is way higher than historical. And we're already at almost a year high on this thing. Well, yeah, we got a lot higher back in February when we had that little bit of panic in the tech stocks and such. But this is the highest we've been since May on this indicator. And in general, I backtested above 13. Do I have this here? Oh, here's the indicator if you want to mess around with it. Okay, here's the backtest. Anytime this gets above 13, it's happened 120 times since 1990. It's been overwhelmingly bullish. And that's where we're at already. At this small little pullback, VIX has already popped up to 21, I believe it's at. So this pullback is probably not going to be a huge, it's probably not even going to be 10%. I mean, 5 to 7% is possible, I suppose, but I'd be shocked if it's 10%. This is when it just crosses above 13, so lower sample size, still very bullish. The momentum in the market's been phenomenal. There's backtests, tons of backtests I could show you on that. But I've said it many times, momentum trumps everything in markets, right? So all the sentiment, all the positioning, it doesn't matter as if the momentum is strong. That is what has probably the best backtest of anything, is just pure momentum studies. And it's pretty flawless returns when you get this kind of a move to this point in the year. And the max drawdown looks like about 6%. So it's another reason why I say we're probably not going to have a huge drawdown here. And you probably want to buy this dip, but I'm kind of waiting for at least one breath washout day under 10th percentile on up issues, and I would like to see, it'd be really nice to see one greater than 45 DIX print as well. Another reason why perhaps people are not as extreme bullish as I think a lot of people think. Percentage of loans on issues, on shares, is quite high compared to historical averages, which means people are borrowing shares to most likely short. And, it could just be hedges. That's fine. If people are hedged, we're probably not going to crash because they're eventually going to monetize those hedges. Okay, I'm going to talk a little bit about permabears and why I don't believe in just discounting things they say and laughing at them and like a lot of people do. That's not how I believe. I think you should have an open mind, and I think you should sometimes some of the things that are said by the people that are always bearish are accurate. And one thing that is accurate, if you just backtest this data, it's just the raw PE data, it isn't necessarily bullish when we get this high. And some people are like, oh, they've been saying valuations since 2014-15. Well, true, but valuations are a lot higher than 14-15 now. So just blindly saying, just ignoring everything they say, I don't believe in that either. While I'm typically more bullish than probably the average FinTwitter and certainly the average YouTuber, I don't believe in completely discounting this, but I think there are flaws with this PE ratio. I think there are probably better ways to value the market. I do believe in adjusting for rates, and I've shown this before. This is what I call PE fair value. It's a free indicator on TradingView that I made. You can just look it up. Anyways, this indicator basically accounts, without getting into all the details again of how it's calculated, I've already done that before. It accounts for the current interest rate in the market. I can't remember if it uses the 10-year. I think it uses the 10-year. It accounts for that and adjusts for what fair value is. So when this line is below zero here, essentially the market is undervalued by this metric. When it's above, it's overvalued. And currently, we're overvalued, but not as bad as we have been historically. And I think that was Shiller. No, that's regular PE. This is PE 10, which is also known as Shiller. And by Shiller standards, look up what Shiller is. I'm not going to explain it, but it's like more of an average PE, cyclically adjusted, I believe. It's second highest, I guess, in history. But those that are saying this is just like .com, it's not. It's not that extreme yet. Certainly, this is starting to get a little concerning, though. That's why I say don't discount it and don't say, well, everything's fine, when potentially this is starting to become an issue. Okay, so another big thing, and so this YouTuber I'm talking about that I was watching this morning, I just had him playing on a side window as I was putting my research together this morning. He shared this chart from Yardini, and I've seen this chart a lot. And why is this chart shared so much? Because it looks the scariest. And he says this is the margin debt level. And he didn't even explain that it's the yearly change, not the margin debt level. And maybe he doesn't even know that. I don't know. Anyways, this is the yearly change in margin debt. And yes, it's been a massive move higher in 1 year. But when you look at it on this chart, you can barely tell. I wish this chart was log scale so you could see things more clearly. But actually, if you really zoom in on that, it almost looks like margin debt has come down recently quite a bit. I'm sure it did go up a lot in early 2020. It skyrocketed after the March crash. But a year ago, it had dropped a lot at the bottom of the March crash. And then so when you look back to that period and compare it to now, it looks like a huge increase in margin debt. And yeah, we have had a big increase in margin debt. But I always like to normalize things because the value of the dollar has gone down over time, right? And the value of the market's gone up over time. I don't know if this is the perfect way to normalize it, but this is just margin debt as a percent of Wilshire 5000. To me, that seems like a pretty good way to do it, and perhaps somebody out there has a better way to do it. But I look at this and I say, well, it doesn't look nearly as bad when you look at it in this capacity, right? So, but he wasn't going to show that because his audience are all bearish, and he wants to appease his audience, right? So, not going to show this, but margin debt, perhaps it's not as bad as some say. Okay, so M2, I've shown this before. Everybody's seen this. M2 had a big increase. Where did that money go? Well, in my opinion, it went two places. It went into stocks. Fund flows have been very large. We've seen these charts floating around a lot too. Fund flows, there's been a lot of inflow. Where did that money go? That M2 money? Equities, clearly. You can see a lot of money went into equities. And then a lot initially went into money markets, money market funds. What is that? It's just cash. So you're going to have a lot of inflow when M2 increases at the rate it did. It has to go somewhere, right? Some of it went into bonds, but obviously not much compared to where it went everywhere else. That money had to go somewhere, so you're going to see gigantic inflow. Is it necessarily bearish, especially when people perhaps put more money into cash than they did stocks? Maybe not. You know, people don't look at the big picture and the entire picture, it seems like, ever. So I'm trying to show you the entire picture of what happened with all that QE. Yes, it was record QE. And that's why you have to adjust everything you're looking at to accommodate that. I'm not saying that we'll never have any issues in the market, but constantly being bearish just doesn't, it's not going to work. Here's just the fund flow more recently. And yes, we've had a lot this year. We've had a lot. And historically, yeah, if you backtest this, yeah, it can cause some problems. And here it is again. We've had some pretty big inflows, especially right near the top, which that's common. That is common. The Fed may taper, but they are not right now. And some people have told me you can't use the Fed as a reason to be bullish. I don't understand why. If the Fed balance sheet is increasing, all things being equal, that's usually bullish. Even when they taper, they're only talking about tapering. Remember, they're only talking about tapering. What's that mean? This line will still go up, but it'll go up more slowly. Tightening is a different story. We're not quite to tightening yet. Even when they get to tightening, it's not inherently bearish immediately. This was March of 18. Yeah, we had Volpocalypse before that. It declined into October, and then finally in October, yes, we started to have some issues with the market. So there's a delay even after you start to taper, oftentimes, or tighten. There's definitely a delay after taper. They tapered here, and it took a while. 15 and 16, we had some sideways and volatility, and under the surface in 15 and 16, it was a bear market in many respects. And that's the other thing that people don't understand. Because of FANG having such a large percentage of the market, we have had bear markets for most stocks several times since 08. Most stocks have seen several bear markets since 08. It's just that the way the indexes are structured right now, you don't see it at the index level as often. So the idea that we haven't had any bear markets and that means we're due, I don't necessarily agree with that. Financial conditions are very easy, basically, there's two ways to look at this. The biggest shocks tend to happen when this is very easy, because people get to the point of taking a lot of risk. And you can see that clearly. This was right before Vol-apocalypse. So the lowest level we had seen in years. This was right before we had a lot of issues in 15, 16. And this was right before March 2020. However, this really is not an issue as long as it remains in a downtrend. When this pops higher, we can have some issues. But a lot of times you get these fake outs where it's not a big issue. So this is more bullish than bearish, although, it's just like a giant breadth divergence. Yes, you see them before a lot of tops, but most of them don't cause a top. That's kind of what this is. Tradewell app, pretty cool little website. I was just kind of playing around a little bit today. This is low and tightening, just talking about, this is yet again financial conditions. If you're very low on this, like less than 0 on this, basically consumer loans are getting easier and not tighter. And for the most part, yes, we have issues from time to time, but for the most part, that's a good thing. When money is easy, it's usually good for the economy. When you run the backtests, yes, the return is below the average return going 60 days forward. But you look at the distribution, it's very close to the average return for the market. It's just shifted slightly to the left. But more often than not, we're bullish when financial conditions are the way they currently are, which is fairly easy. That's it, guys. I don't think this went near as long as I thought it was going to go. Does it even show? Does it show it? Yeah, I guess it's gone almost 40 minutes. So I didn't put probabilities out there on this one. I don't think I'm going to do that as much, and I'm not going to talk about positioning as much because I get into this issue where I take a lot of breaks from YouTube and from Twitter. And I've had people go, hey, are you still in that trade? Or are you still bullish? You still bearish? Because I don't, even if I do it once a week, it's not enough necessarily to keep up with the market. So I don't want to do that anymore. I don't want people to, first of all, you shouldn't follow me into trades. You should never do that. You need to figure out your own way to analyze the market and your own trading methodology. And try to make a method that, like for instance, in the last couple months, I have traded far from optimally and far from the best I've ever traded. Not traded super well, and my account has still gone up. That's because the way I structured my trading system and methodology, I've structured it in a way that allows me to trade not optimally and still make the needle go up. So I've still made money despite not trading that well. So if you're going to try to make a trading system, even if it's a heavily discretionary one, which mine is very heavily discretionary, but I backtest the data that I use. I just take that data, throw it into my brain, and I make a discretionary call with it. But yeah, your system should hopefully be good enough that you can not be perfect and make money. If your system requires perfection to make money, you need a new system. If your system is trading the S&P 500 on a swing and position basis like I do, and I do some short-term trading too, but the bulk of my account is in swing and position trading, the indexes. I also trade stocks. I swing trade and position trade stocks, and I have long-term investments in stocks as well. But the bulk of my trading account is in the index position trading strategy, because that's where I believe I have the biggest edge. I don't think I have a giant edge in day trading, although I am making some alpha off of that. And if you look at the statistics on day trading, you'll understand why I want that route. Yeah, I've had day traders come to me and go, "Why don't you talk about day trading more? That's where everybody makes the most money." And that's not true. Look at the statistics on day trading. Most people fail day trading. The better percentages come with the longer term. Look at the S&P 500 chart and the long-term upwards bias there. There's more money in being patient and being long a lot on the S&P 500. That's the way I trade the S&P 500. I am usually long the S&P 500. There's rare times I will go cash. There's rare times, very, very rare times I will go short. I'm usually long. And I've had people say, well, you're going to go bankrupt in a bear market. I survived March 2020 extremely well. I've survived 2015, 2016 extremely well. So I guess it's possible, but I've accounted for that. I have systems in place for that. Yeah, I don't know, I've ranted a lot in this video, but there's just so much bad information out there, guys. And most of the time, when I make these videos, I'm just kind of talking into the void because I don't get a lot of views, which I don't care. I don't care about views. I'm not trying to make money on YouTube or anything like that. I'm not really selling any services. I sell one book, and I thought long and hard about giving that book away for free, actually. Like, I have given away everything else for free, but I wanted some sort of way to gatekeep my Discord room because I kept getting bots and crypto people and just crazy people would come into the Discord. It was a free Discord I ran for many years, and I was just tired of dealing with idiots. So I needed a way to gatekeep it. So if you buy the book that's on Amazon, it's in the description, you can get into the Discord for life for a one-time fee of $30. It's not a trading service. It's way cheaper than everything else out there. No subscription. And that's probably the only thing I'll ever sell, although I wouldn't discount the idea that maybe I could sell something else in the future, but it's probably unlikely because it was a lot of work to do that. Yeah, I've just been ranting and rambling, guys. But anyways, the probabilities, I would say, I think there's a decent probability we see like a 2019 fall repeat, and then we're really bullish into the end of the year and bullish early next year. That's what I think. And once I get that breath washout day, once we start to see DIX improve, I definitely want to get somewhat aggressive with buying back. I still have a pretty high cash position, so that's where we're at. Probably see you in the next video whenever that happens to be. See you guys.